This comes at a time where we're finally seeing Australian stocks, after a terrible year last year, getting some love. Do you think the road to normalisation is priced in at the moment?
No, I think what the equity markets are really illustrating is the growth rebound that we're seeing in Australia, the relatively positive outlook in terms of the region that we're seeing here locally compared with the quite contained viral cases, notwithstanding the most recent news. And the fact that we do have that momentum building in the consumer side with the unemployment rate falling, sentiment high, the wealth effect in the housing market really feeding into sort of still quite relatively strong GDP numbers. And that's what's being reflected in the equity market, as well as that, obviously, the high commodity prices are helping the metals and mining sector. And I think there's still room to go further in terms of the Australian equity market, particularly as investors look for income and dividends to start coming through more and more.
Let me bring you to the question of the day on our Markets Live blog, which hints at what we heard from Chinese authorities in terms of the reserve requirement for their banks, trying to dampen some of the rise that we've seen in the yuan, but also, of course, their jawboning and measures around clamping down on commodities rally as well. The question of the day really asking, how do these moves that we see from Beijing potentially affect broader assets, right? Is there a concern, particularly, I suppose, on the commodities side, if China continues to do what it wants, which is to try and get prices lower?
You know, the one loser, I guess, if you want to put it that way, from having the high iron ore prices is obviously China. They want a low price. The reason it would still maintain a certain level of value is that you're still seeing quite high steel demand. Steel spreads are still pretty elevated. There's still an incentive to create that, and that should keep iron ore prices at a relatively high level compared to history. You know, will it touch the highs that it reached earlier this year? Maybe not, because you will see some of that sentiment change, some of that jawboning, as you mentioned, from Chinese officials to try and bring it down. And it's not the first time we've seen that. So I think the outlook for commodity prices varies across the sector. But if we think about iron ore, we think about copper, there's still strong demand there, and there's still scope for limited supply that's been affected by COVID and weather-related effects, which should really underpin those prices.
Now, Kerry, you still have inflation as a top risk. On the inflation front, how are you factoring in the risk of supply chain disruptions in Asia from the lockdowns we've seen imposed in the region of late? And does this give central banks something to worry about?
I think it does, because we look at the inflation outlook and we look at what central banks are telling us, and it's really about inflation being hit by these one-off effects from last year. And there's a risk that it becomes a little bit more sticky in terms of these one-off events, whether it's the base effects from last year, the ongoing disruption to supply chains from COVID around the Asian region, and particularly around semiconductors, and the risk that this sort of one-off event become a one-off event every month for the next few months, and inflation remains a bit higher than expected. You know, we do believe that inflation will come off the highs that it has seen, and it will start to come down, and eventually supply will come back to meet that accelerated demand. But we do think that we look at the labour market, particularly in the US, and there is a real risk that that wage growth is a bit firmer, that inflation is a bit stickier than the Federal Reserve is telling us. And we do bring forward those expectations around tapering and those rate hikes coming through much earlier than the Federal Reserve is actually telling us. I think the inflation outlook is a risk because it is just so unknown at the moment, and it will take a number of months to really get a true idea of whether we'll see that inflation being persistently higher or not. And there's just many moving variables when it comes to thinking about all the underpinning forces driving inflation at the moment.
And Kerry, what does that mean for the trajectory for yields? We've seen Treasury yields pretty much range-bound.
Yeah, they haven't really done much since March of this year. We saw an aggressive move in the earlier part of the year as we just really saw markets reflect the better economic growth and inflation outlook on the back of that. We have seen a lot more movement as the difference between real yields and break-evens and how they've sort of moved together and apart. And at the moment, they're moving apart with break-evens rising a lot more than we're seeing in the real yield space. And that divergence is not something we've seen for some time, so it does raise that risk around a taper tantrum. Again, our view is that given the sort of unknown quantity around inflation, there's still somewhat risk to the downside globally from the vaccine rollout and from the virus, but also the upside from fiscal stimulus coming through, that inflation is likely to be something that consistently pushes yields higher, but it will probably be more of a slow grind into the end of the year. And we're not expecting anything that's going to trigger a massive upside until we do see those inflation prints becoming a lot more persistent. The other thing we'd watch out for in the near term is, again, the corporate action. If we do look at the earnings season coming up in the US, we hear a lot more from companies around the supply pressures coming through. We could start that to be reflected in a bit more nerves in markets around that, really translating into margin pressures and potentially that pass-through cost to consumers as well.
Kerry, we're starting to see valuation metrics come down across Asia, right? Are there bargains to be had here now, particularly if you take a look at potentially reinvesting some of the gains made in Europe and the US back into this part of the world?
We're always looking for whether valuations are the most attractive, but I think right now the focus is really on the earnings outlook, given that valuations are still pretty elevated around the world when it comes to equity markets. We know that there's going to be a valuation drag across the markets this year because of that, so you need that upside from earnings to offset that. Our preference is to look at developed markets at the moment and mainly focus on the European story. The risks that come with the Asian story are really around the lockdowns we're seeing imposed, the potential hits from the supply chain disruptions. And we do still tend to focus on China for the long run story, notwithstanding some of the pressures that have been faced there around the technology stocks and some of the official action that's been taken. I think that when it comes to Asia, it'll be positive in terms of those economies which are much more in tune with that global reopening. So we do look towards Korea and China. We need to offset that, Korea and Taiwan. We need to offset that with some of the COVID numbers that are coming out. And our preference is to really think about developed markets in this context. We think that EM will be a bit of a lag story. It will catch up later on, but the earnings outlook is much more strong in Europe at the moment.
And Kerry, on Europe, we've seen the Stoxx 600 cap a 4-month gain. What fresh catalyst could keep this momentum going into a season that is historically weak for European stocks? And can the ECB hold off on talking about tapering given where inflation is headed?
I think the ECB will be a laggard when it comes to thinking about tapering. I mean, the inflation outlook there is much more muted than we're seeing in the US and other developed markets. I think there's some way from thinking about really a lot of the more sustained pressures that come through in inflation and also their bond purchasing program. Now, some of the emergency policies they put in place may be reduced a little bit, but they will maintain that bond buying program for much longer than we think about potentially the Fed doing so to support the economy. We are only at the very early stages of that reopening that's happening. We still expect a lot more consumer demand to come through. And we're also having that lagged effect from the European Recovery Fund, which was a bit delayed through some of the political processes, still to come into the market and create that upside from the fiscal outlook. So I think there's a lot more potential in Europe. It's a market that has been unloved for some time. There's a lot more potential flows to hit in there to push those market valuations higher. And the valuation around the growth story and the valuations around the value story and the cyclical story still look somewhat appealing there.